D'un côté, la croissance rapide de l'intérêt des investisseurs pour la finance durable, les facteurs environnementaux comme les changements climatiques et sociaux, tels que la croissance des inégalités ou la diversité et l'inclusion, sont aujourd'hui incontournables dans notre contexte d'investissement. D'un autre côté, l'intelligence artificielle prend une place de plus en plus importante à plusieurs niveaux pour soutenir notre compréhension et modéliser des phénomènes qui peuvent affecter les marchés et pour mieux saisir les risques et les opportunités qui peuvent se présenter devant nous. Mais comment que l'intelligence artificielle peut-elle soutenir l'évolution de la finance durable et nous permettre de mieux faire comme investisseurs dans ce domaine? L'utilisation des nouvelles technologies de manière intégrée permet-elle d'augmenter la quantité de données environnementales disponibles, mais aussi de s'assurer qu'elles soient fiables et qu'on soit en mesure de bien les valoriser pour avoir des analyses qui sont justes, complètes et pertinentes? To provide some answers to these questions, let me introduce our panelists. So, Mr. Christiaen, Sustainable Finance Lead Satellite Application Catapult. Hi, Christian. Sakis Kotsantonis, Chief Executive Officer, Richmond Global Science. Hi, Sakis. Karen Karniol-Tambour, Head of Investment Research at Bridgewater. Hi, Karen. Nice to meet you. So, right, we'll start to get into, we'll dive into the poll right now. So my first question is for our panel is, the theme of this panel is artificial intelligence and sustainable finance. We could also call it sustainable digital finance. My question is directed to all of you, but first thing first, how would you describe the interconnections between sustainable finance and AI? Maybe Karen, you want to jump in?
Well, I would say, thank you, Alexandre. I'm really excited to be here with such an esteemed panel. I would say I was really excited when I saw the title of this panel, because to me, the intersection of sustainable finance and AI can be summed up in one word for me, which is scale. Actually being able to do it at scale. A few years ago, lots of discussion about sustainable finance, but honestly, in a lot of places, mostly lip service, because of the fact that if you're picking investments one by one, and you put a really great team on the ground and they get you a very exciting investment and it's, $10 million in size, that team might be very excited about it. But for most global pools of capital in the world, it just doesn't move the needle. It's a tiny, tiny, tiny drop in the bucket. And it can be a very glossy few pages in your annual report, but that's about it. It's a very, very small percentage of what you do. And so if you want to actually affect how large pools of capital invest, then you have to be thinking at a whole portfolio scale. You have to be thinking about being able to look at every company in the world, every asset class in the world, and think about a whole portfolio solution. And for that, you need technology. You need to actually be able to systemize what you're doing. You can't have, a brilliant investor on every dollar you're investing. You have to be able to do it at scale. And so to me, that is the key of why these two topics live so closely together. You don't have to think about it like the fanciest AI you've ever heard that's doing the most extreme applications. But you absolutely need to apply technology, apply systemization to look at the problem at scale in order to move any serious amount of capital towards sustainable solutions.
Thank you, Karen. Maybe Christophe or Sakis want to add something onto this interconnection between AI and ESG.
I can go ahead. I will have started with scale, but Karen kind of led the way. So I'm going to add to that, identify new insights and patterns. So scale is about analyzing vast number of companies, but we need to actually understand new patterns, behaviors, and insights by using AI. And that requires processing vast amounts of data that would be hard for humans to do, basically, to spot those patterns between data sources. So, for example, now we can use weather data. We can actually use, for example, environmental disasters and relate this to default risk for companies. It could be SMEs, it could be large companies, and so on. So I would say, on top of scale, these new insights and patterns we can get by the ability to analyze vast data sources.
Christophe, you want to add something on that topic?
Yes. Also, first of all, thanks, Alexandre, for inviting me to be part of this panel. I'm really excited to be here from across at the UK. So it's getting dark here while it's getting light at your end, I guess. But I think to add, for me, the interconnection of sustainable finance and AI, or really kind of digital technologies in finance is it really creates an opportunity to bring the kind of sustainable angle of sustainable finance much more to the forefront. We've talked about scale and of kind of the huge quantities of data involved, but I think the exciting bit is that AI allows for a whole new range of data sets to actually be analyzed and interpreted in this financial decision making, whereas financial data is fairly well understood. It's available in standard formats, and it's clear how it can be interpreted to understand credit risk or profitability or whatever. It's much less clear, or it's only now really coming clear on how sustainability data can be relevant and how and where. So AI and other digital technologies, and one that we work with a lot, particularly satellite data and geospatial data sets, they really create an opportunity to make sense of these data sets in terms of processing much more data much faster, synthesizing this, allowing for automation, again, in a kind of much more near real-time or actionable way, and identifying patterns by mixing different types of data sets, predicting behavior in ways that before you didn't at all consider when you were looking at these things. So for me, it's really about bringing together a whole range of new data sets linked to the sustainability side of things to financial decision-making.
Thank you, Christophe. As we all know, we collectively have to face a major crisis. The COVID-19 pandemic has had an unprecedented impact on economies and population worldwide. For instance, climate change already have major impacts on every continent and was described in January by the World Economic Forum as the most important risk businesses are facing. Now, how can AI help tackle environmental and social challenges of an unprecedented size and extent? And Karen, you were talking about scale of the portfolio, scale of the insight that we need. Maybe you can share some thoughts around how can AI help tackle these big challenges as a society is facing.
Let me make a couple points. I think that, when you're looking at something like COVID-19 happening, you have such a rapid transformation in what the economy is actually doing. You're looking at how people are spending in ways that are not the traditional sector splits, right? And so the ability to apply new types of data, both to cut up the economy into different sections that were relevant in this crisis and were never relevant before, and to look at spending live in different ways. Whoever thought that things like mobility data would become a critical economic indicator that tells you very, very important things? It would take a crisis like the COVID-19 crisis to realize just how important the ability to process and look at new different types of data is. And then when you think about long-term challenges, the example of how to apply finance at scale to something like what we've chosen to do at Bridgewater is sustainable development goals, which obviously are agreed upon set of goals that almost every country in the world has signed on to. But if you want to every day look at every company in the world and tell you which companies have business lines and activities that are actually contributing to achieving these kinds of goals and direct your money there, you need a tremendous amount of sustainability, of scalability and data to be able to process that every day and tell you what companies you want to be invested in. And that kind of systemization is really only enabled by good enough technology that will let you do it. And otherwise, you really can't move money at scale towards a problem like the Sustainable Development Goals. And the scale of cash that has been estimated that needs to move towards financing those solutions is massive. We will need the data to do it.
Absolutely. Maybe Christophe or Sakis want to add on this question.
It's actually a very interesting question, especially with COVID. I was part of a research that was looking into the COVID response by BRT signatories, Business Roundtable signatories. And the first things we did is try to look for data for this. And there was none actually on the conventional space, because we will have to wait for a sustainability report that will come next year. And we look on the alternative space, and we're lucky enough to collaborate with a company called True Value Labs that gave us sentiment data on specific indicators that we asked for around COVID. And that was fantastic, right? Because then we could see a company's response to COVID, for example, policies that help the employees, but also what the employees feel about these policies. And we can argue about the pros and cons of sentiment analysis, but this takes this to the next level, real-time information for something that's developing as of today, rather than being subject to the cycle of sustainability reports, which we will have to wait next year to see what companies did.
Thank you, Sakis. I think one key element that Karen and Sakis are discussing around the ability to take data, to take insight, and get to the movement of cash, or the decision-making process of shifting these flows of funds. And that reminds me about the flow of data, because I think to enable this technology and this general purpose technology that is AI, the data flows are very important. So that brings me to the question around all the data and this availability. So data and our ability to produce scenarios around hold on a second, sorry. I'm just going to go back. Data and our ability to produce scenarios that able to evolve are the art of the sustainable finance. But global challenges that develop over a long period of time require enormous amount of data. Christophe, what do you need to be done to increase our access to data that escape right now the greatest use of AI and algorithm? Is that this data capture? Do we need to create new form of data, or how do you see this going?
Thanks, Alexandre. So for me and from the industry that I'm involved in, I don't think that the volumes or the quantity of data is the issue. There is a lot of data available that can be relevant for the sustainable finance agenda and sustainability issues in general. A lot of this is unstructured data, or is new alternative data for the financial sector, particularly the sector which I work in, which is space and the satellite data. So what we have seen in the last couple of years is that, volume and quality-wise, these geospatial data sets and satellite Earth observation data, they have grown exponentially. So they've grown a lot, and this is both driven by kind of private companies like Planet or GHGSat, but also public institutions like NASA and the European Space Agency. They are sending satellites, and they're basically collecting terabytes of data about the state of our planet every day. And this is data that's available for free. So we have huge data sets, huge quantities of data, high quality data that tell us about what's happening day in, day out. It's just kind of sitting there. So AI and cloud computing, other processing techniques that you can imagine, they make these data sets in theory already much more accessible. But the challenge, or the main challenge that we see really in kind of driving action for sustainable finance, is that many financial institutions, for them, it's not yet clear what they can do with the data or why. So more than a kind of data quantity or processing challenge, we see a translation challenge really around translating these raw data sets, unstructured data, into relevant decision-ready insights for financial decision-making. Now, this means we need to get a better understanding of what type of signals we're looking for. What is it actually that is material for specific industries, for specific use cases or financial institutions? And the opportunities, I mean, it's quite broad and varied. So there's a lot that can be done, but the kind of uptake we really see is lagging. So it's more of an uptake or translation challenge in our respect than a data or technology challenge.
Maybe, Christophe, for the audience, do you have a couple of concrete example for them? So how can we apply data to these type of, and tackle these type of issues?
Cool. So we work a lot with kind of satellite data and AI-driven analytics for finance. And traditionally, we've seen these applications being used in insurance for natural catastrophe modeling or kind of post-disaster rapid damage assessments that can then trigger payouts at scale, etc. We've also seen these techniques being used in kind of commodity trading to understand how supply and demand triggers are changing across the world, which could impact commodity prices like oil or even metals, etc. But increasingly, we're seeing much more tailored applications to climate and environmental issues, for example. Physical climate risk can actually be assessed much more granularly using satellite and geospatial data sets, really from the kind of individual site or asset level onwards, which you can then aggregate upwards to the kind of company level or the portfolio level from an asset owner or a bank, for example. The kind of data and technology we're working with really allows to kind of zoom in detail, a kind of very high resolution of specific hazards like coastal inundation, coastal flooding, heat stress, or wildfire risk, for example. which we can then translate upwards to exposures across portfolios. We've also seen applicational solutions where the data is used to create, for example, parametric insurance products or microinsurance products, where the data is used to trigger payouts based on specific thresholds being reached. So that really brings down the cost of the creation of these type of products and allows you to reach markets where previously the cost of offering insurance was unaffordable for both the kind of provider and the taker, particularly in emerging markets. And then one example I think that we've recently seen is very much also on a kind of environmental and biodiversity side. For example, satellite monitoring tools really allow deforestation to be monitored in kind of near real time, and there's a lot of issues, challenges about deforestation in the Amazon, but equally tropical deforestation linked to commodity supply chain like palm oil or cocoa or coffee, etc. And we're starting to see, for example, there's a group of asset owners, I think in the Netherlands, led by Robeco, who have set up a kind of engagement campaign with the companies in their portfolio that are either directly producing palm oil or are dependent on palm oil as inputs in their processes, to engage these companies based on evidence and kind of much more near real-time analytics about what's happening on these concessions, about what's happening in the areas that they're sourcing from. So you can really start to use these tools for a range of use cases, if you like, from engagement to kind of investment and risk decision making. And there's so much more that can be done. Once the kind of translation issue, if you like, gets solved.
Thank you, Christophe. Maybe Karen, you can comment on this, because we all know that Bridgewater is by far a very sophisticated investor and a very data-driven organization. And without revealing any top secret information from the secret sauce that you guys are using, maybe you want to comment on use cases or things that you guys are looking for into that.
Absolutely. And I think, Christophe, you were spot on in saying there is so much data out there. Actually, the barrier is much more thinking in a structured way. What do I need to know? What am I actually trying to answer? And then let me go find the data to put it in, rather than being stuck and saying there's no data to answer my questions. I'll give a couple of examples. If you kind of think about ES and G, I think S is kind of sometimes the least spoken about, the social part. And the social things people love talking about in kind of a cocktail conversation kind of way, but there is actually a lot of structured data that can be created around it. So as an example, there's a lot of discussion about populism risk. Isn't populism a big phenomenon in the world and risk for what's going on? And in our view, that's actually something that can be measured. We've gone through and said, let's look at every election that's taken place in every, one of the major countries and have rules to classify what would a populist outcome look like, and then create a data set of, what does the populism look like? And that actually confirms a lot of the intuition that populism is at the highest level it's been since the World War II era. But that's real structured data that, kind of can actually be created. Another element is GDP. We've come from a world for, 50, 70 years where GDP was a very good proxy for prosperity. And so it was a very, very good proxy for policymakers and investors to say, if GDP is going up, things are good. And what's happening now is there's a whole set of industries around tracking GDP in the most minute ways. People can estimate GDP a little bit before it happened. And every piece of GDP, I can tell you exactly what's going to happen with it. But the realization is shifting that in a lot of the world, it's not a very good measure anymore for prosperity, GDP. They've actually had periods now since the financial crisis where GDP went up, and at the same time, different groups were left behind, inequalities increased, and so on and so forth. And then we need different ways of measuring whether actually prosperity is going up, and that's mattering more and more to policymakers and to investors. So that's a new set of data industries that'll have to develop that'll be just as sophisticated as our ability to track GDP, per the minute, per the second, and comes from kind of asking, what is the question I need to ask? And then I'll just very briefly comment on the E, because there is so much that's developing about how to analyze climate risk. And the biggest thing that I think is very important to remember, that in some ways the COVID crisis reminds us of the most, is that climate issues are really about tail risks, about what are all the possibilities of what could happen in terms of the climate. And so you have to be asking those questions. And if you think about the analogy to COVID, if you had all the analysis about what would pandemics do, before COVID hit, it would tell you that in 9 out of 10 cases, maybe 98 out of 100 cases, pandemics don't matter very much to investors. Pandemics are pretty much controlled and are kind of a blip. And it only took a very small change in the type of virus that you got to create a completely different outcome for the world. And so that means that just saying what is the kind of down the middle modeling and the most basic outcome is not going to be sufficient. And climate looks a lot like that. There are a lot of cases where you can say in a certain country or a certain region or a certain industry, climate is kind of, this is how much it will matter, and it can be measured very simply. And you need much more complex thinking to realize that you could get a very different outcome depending on very small changes in how fast, ice caps will melt, how much emissions there will be, and so on and so forth.
Thank you, Karen. I think
Alexandre, if we have 1 minute for this question.
No problem. Go ahead, Sakis.
Can I be slightly controversial? I'm going to offer the other side of the story. I think the data flows right now are not where they should be. And let me frame the why, right? As somebody who has actually helped companies produce sustainability reports, it is all over the place. You ask a simple question, go to any large publicly listed company and try to figure out simple questions, right? Revenues per segment, per geography, or even the simplest one, how many employees you have. It took weeks to get an answer. When we went to part-time, full-time contractors, who should be accounted for, and so on. And right now, the data flow is from some sort of operation to the Word document. It's all over the place. And then it starts getting aggregated to a sustainability officer that communicates that to a sustainability report. And then a data aggregator will take that, process it, and digest it on the other side according to their view. And there's only a handful of data providers that give you raw data. And then when you look at that, Karen touched on this, you will see on the social side, 80% data gaps. And on the environmental side, probably 40%, right? So, and every other data point gets modeled. And then we can debate about the accuracy of models that use only 10% of the information to predict the other 90%. We still have a long way to go to have enough coverage and availability. So I would say working on those data flows and maybe something more advanced that goes from, the factory, where the data is produced to the user of the information. And Christophe actually is using a lot more advanced data that probably alludes more to that model, would be very, very beneficial to take it to the next level.
I think it's a very good segue, Sakis, to my fourth question around the growing needs of ESG information. Because the international securities regulator in different markets, they ask for the 5 most influential ESG standard groups, such as the Carbon Disclosure Project, the Global Reporting Initiative, the Sustainability Accounting Standard Boards, to work toward alignment their books of standards to provide more transparency. Because the data collected on investors and companies in terms of ESG should therefore become more standardized. We see a lot of things, and I don't want to call this the far west because there's some good things around there, but there's also some things that need to be refined and improve. But how do you believe that this development will help advance AI, and where are we in terms of maturity, in terms of data? I would say quality, and I won't say quality because there's many meanings, but really the usefulness of this data around as an input to the insight process and the overall decision-making process.
This is an excellent question, and I think this is a step towards the right direction. Until we have an agreed framework that becomes a standard, which is comprehensive, and until then, most organizations will report their policies in reports. And then we spend hundreds, if not thousands, of research hours reading them, engaging with companies, trying to figure out what they're doing. And the majority of the information right now that dominates research and ESG indices is company self-reported data. But if we don't have regulation around this, investors are overwhelmed by these data gaps and efforts to greenwash. This creates a lot of problems. I actually wrote a paper with George Serafim from Harvard Business School. We call it the 4 things no one would tell you about ESG data. And one of the key problems we identified is the sheer variety and consistency and of the data and measures creates a lot of problems. For example, we found 20 different ways companies report their employee health and safety data, which I would say it's probably one of the easiest ones to report. And these inconsistencies lead to different results. When you look literally at the same company, you get different results in the same group of companies. So this is definitely standardizing is the step towards the right direction. If you're asking me where we are in terms of maturity, probably in the 1930s when the accounting standards were established. This is where GAAP, I think, was established. So this is where we are. We need the standardization, but this is not a 2021 solution, right? But if we do get the standardization, then you can apply AI models. You can apply natural language processing in a more efficient way, create those efficiencies to read those documents. And again, don't get me wrong, we're in a much better shape than we were 15 years ago. But once we get the standardization, coverage will come in, reliability will come in through audit, and so on. So we definitely need that. But we need to get that baseline until we start applying more advanced models on top of it.
Maybe Christophe or Karen want to comment on this topic of data standardization.
Just that it's so, your comments are very well said. Very, very true. I'll just add the investor side, which is that the investor confusion from so many standards is huge. And it's not reasonable to put every investor and every fund in a position of having to sort that out and having to figure out what is the right standard of them. And that'll help tremendously. The other piece is that, again, our goal here is actually to move capital towards solutions. And if everyone's handling a different data standard, then you don't actually get a tremendous amount of capital moving towards one answer. If you just get zero correlation between all the data sets, you're not getting very much movement toward any one thing. And lastly, there's certain asset classes where without more standardization, it actually, that whole scale point that we all agreed on early on can't be achieved. And so the best example I would have for this is, anything to do with trying to move real money towards green investing in infrastructure. If that could be done in a way where you actually had an asset class that could be securitized in large size and not done via small little chunks, you could get much bigger amounts of capital moving there. To do that, you need some agreed upon standards of what fits in to a piece that would be securitized. And so there are certain whole asset classes where a lot of global money could move in the direction of making impact once there's more agreement on what data standard is actually the right one. And then that enables things like securitization to happen at a much bigger scale.
Thank you, Karen. Christophe?
Yeah, thanks. I think fully agree with what has been said. I think the whole kind of standardization topic or debate is interesting and relevant, but I feel like it sometimes goes besides the point. I think disclosure and the data is one thing, but what do we need or use it for? I mean, when I hear Sakis say that a lot of these companies themselves don't have this information centrally in a specific place that they're reporting on, it's like you can't manage what you can measure, right? So if they don't have it readily available in a way that is manageable for them at the top, is the top actually managing it? So I think that's a kind of question. And another one is around, they will report on which policies they have in place or whatnot, quite kind of qualitative typically, rather than offering means to actually monitor progress against any of these policies in a kind of verifiable, transparent way. So something that we were promoting also when we engage with some of these standard setting bodies is at least from a reporting perspective to start disclosing also asset level data and asset level information, so that at least when companies either disclose where their kind of key production assets are, or their key commercial assets, or their key supply chains, and or some kind of basic information associated with it, you can as a third party, you can overlay more objective data sets. Again, I'm very much promoting geospatial and satellite data set, but it allows you to kind of do that fundamental bottom-up analysis on your own with other kind of objective or third party, other type of data sets to do some of the analysis of risk exposure, etc. Yourself, rather than relying on what the company says, if they say it, and actually if it's unstandardized or not. So I think there's even if standardization is solved across these standard setting bodies, there's still limitations of the fact that it's disclosed information itself, and that there's only, I guess, so much that it tells you. And depending on what you're trying to achieve, is it allocating capital to certain types of clean tech or whatever, or taking away from kind of financing bad or whatnot? I mean, it may be more or less relevant for some of these decisions, right? And for other type of sustainable finance decisions, you can find relevant enough information to draw these decisions. So, yeah, I think the standardization is not going to be, because everyone always talks about it, but it's not gonna solve everything or even half of the challenges we're faced with.
Thank you, Christophe. In the last 30 minutes, we discussed around the interconnection between AI and the sustainable finance. Second, we talk about the data collection, the data input, the data standardization, the level of maturity, and the challenges also around the world, around the COVID and the pandemic, and then all the social challenge that the world is living. But let's go back to the angle of the investment side, like how we face investment and business risk around ESG. And my question is around how does ESG risks on businesses' investments are both increasing very rapidly. For example, modeling dynamic long-term social and environmental trends, like we were discussing around how we can use AI and these type of insight or advanced analytics on different types of assets can help better understand financial risk exposure that we are getting into. Because as an investor, like Karen was saying, we're moving capital across different asset class, and that we need to understand and clearly mitigate the information asymmetry. So, what else do we need to do more accurately to assess the risk as an investor? What technology, practice, methodology to better support our framework of risk or to improve our decision-making process. So I'd like to hear from all of you, but maybe I will start from Karen because of the Bridgewater role into this process. I'm sure it's part of the investment process. So Karen.
Thanks. Well, I would think about it this way. When you're investing, the core thing you're doing is you're trying to predict what will happen in the world. You're looking out in the world, and when you're buying an investment, there's future value there relative to money you're putting in today. You have to have an outward-looking view of what will happen in the future. And right now, it's almost impossible to imagine kind of an intelligent conversation about what's happening in the world and where it's going on any topic that is not going to hit key themes that we seem to talk about in terms of sustainability. We're going to end up speaking about the quality of governance in the world and whether or not it will be effective to get any legislation passed in a place like the United States, or whether there'll be bipartisanship, what will happen with issues like Brexit. We're going to end up talking about social issues and whether there'll be unrest and what it really means to have quality of well-being, and therefore what companies will try to pursue and what governments will try to pursue. And of course, we'll end up talking about environmental risks and how climate will play in, or just quality of air and how that's going to change regulatory policy and what people are like. So once you're looking at a world where you can't look at the world and try to predict the future not thinking about these issues, it becomes very embedded to whatever analysis you're doing on any investment. These issues will be pertinent to that investment in a key way, because that's actually that important to what's going on in the world. And, we had spoken a little bit about COVID and how it hit things. I think that before COVID, it was more common for us to get questions like, are you sure climate's actually important? And COVID in some ways made it more intuitive that things like this in the natural world can come and affect everything around us in a very dramatic way. So it's becoming much more intuitive to, I think, investors that this is a very critical issue. And I think that the other big backdrop is that because monetary policy has gotten to where it has, where interest rates have been zero for about 10 years, there's already been a lot of quantitative easing and so on and so forth, that the big role that monetary policy has played in most investors' investing life is kind of behind us. Fiscal policy is moving into that same place where that is the most effective kind of policy. In fact, the most effective kind of policy going forward is what we've called monetary policy 3, really the combination of doing both monetary printing and having fiscal policy. And what that means is that relative to 10 or 20 years ago, all these social issues or governance issues are a lot more important than they were, for the simple reason that fiscal policy is inherently distributional. It's inherently social. It's meant to be choosing who is going to receive what. Whereas monetary policy is more technocratic. The goal of fiscal policy is much more to decide how to distribute the resources, to make regulation, to decide whether or not coal is going to be allowed or whether or not we're going to get our energy via cleaner ways. And so we're also in a world where, because of that secular backdrop where interest rates are already zero and so on, all of these issues are a much bigger part of the policy process that's the backdrop to every investment than they have been in a very long time. And COVID is really, we're seeing fiscal policies play the biggest role they have in economies basically at any time in recorded history over COVID. And that's much more likely to be the norm than the exception going forward.
Thank you. Sakis, you want to comment on this? Maybe with an example on what you see?
So in terms of predicting trends and using data for risk analysis and so on, I would say one of the things that I think is important, and we'll see more in the future, is working a little bit on the impacts companies are having through the products and services, which is a blind spot right now on the ESG data landscape. So, for example, we have operational impacts like CO2 emissions, water withdrawals, very important. But you can get that right. And for example, you're a food industry company and the products that you put on the shelves have excess sugar or fat, right? And these are adding to the biggest health problems of our time. Just to give some context, if we're looking at the food industry, dietary habits are closely linked to cardiovascular disease and diabetes. And these are leading causes of death in the US with a price tag of over $500 billion per year. So thinking about risks, but also opportunities. What if we can actually collect data from thousands of products, nutritional data, for example, salt, sugar, relate this to medical research, like the probability of getting sick, and then link that to brands or companies at the aggregate level, and then perform some really powerful analysis on consumer behaviors, new product development, sales growth. And that is not just on the risk side, it's also on the opportunity side of ESG. So this is where I see a tremendous potential for AI to add value from an investor perspective in identifying forward-looking trends, the kind of trends that Karen was talking about.
Thank you, Sakis. Do you see, maybe for all of you, do you see a sector that we can look for good practices in terms of AI and what the investors facing in terms of, is there any, do you talk about a bit about the food industry? Is there any other industries that come to your mind and say, okay, this is, I think there's either a good start, a good beginning, or they're more matured in other industry, maybe?
Most B2C industries have a vast array of data that you can use to understand behavioral patterns. With B2B, it's a lot more complicated, and you need to think more about the methodology or the system you're going to use. But any B2C industry right now has a wealth of information that you can extract. ESG plus, I will call it ESG plus because not all of this needs to be coined as ESG. Again, it's products and services. So if we're talking about products and services, I would say any B2C.
Christophe, you want to add something on the industry and how the investor exposure on these on the company and the industries? You want to add?
So I think what Sakis said is, I think that's absolutely true. Probably the ones who are using these technologies best are, well, any digital company or anyone kind of looking at consumer trends and directly doing this big data mining to sell more and more products. I think where it's very much kind of lagging behind is applying these AI techniques for different purposes than pure selling, like the risk management or the impact measurement and some of these areas. In terms of sectors where, at least from our side, we see spatial data and at scale being actually used much more effectively. I think the kind of agriculture is very much and kind of agribusiness, big agri, very much using a lot of these huge spatial data sets. Makes sense for them. It's relevant. Combining this with weather, climate information and other types of information like yields and productivity, etc. So I think there's a lot of skill there, but mining is starting to take it up a bit. But yeah, I think in general it varies. I think the advances in the kind of operational or risk management side are much slower than in the kind of consumer driven side, as Sakis said.
Thank you, Christophe. Maybe a follow-up question on this is universities, financial institutions, fintech, ESG, all players, all the ecosystems around this can work together really to accelerate the integration of AI in the process of ESG, either by indices, by enabling more data. What's your take on this? Do you feel that all the stakeholders are working together? We talked a bit sooner about the standards. The standards is one thing, is establishing the container, but the thing that goes into the container, the liquid, that this data is. Do you feel that all this ecosystem is working together, or is really pushing? And maybe your take on this. Maybe I can start with Christophe.
Yeah, I think there's a huge potential for improvement. I think on the data side, to start with, when we talk about ESG or climate, these are extremely complex issues. They're inherently complex. They're not just typically a single field or a single area of expertise that you need to understand risks or opportunities or impact. So they're inherently kind of multidisciplinary. So I think from a data and ESG data perspective, I think there's some quick wins there, if you like, by either collaborating with universities or just collaborating closer across sectors and other areas of expertise than kind of your own silo. And we're trying to push this, but it's I guess, yeah, there's a lot of potential still. I think another beneficial, I guess, collaboration or trend which we hope to see in the future as well is that actually some of these different disciplines that are traditionally maybe not been used or relevant in financial investment decision making or any other type of financial decision are actually being invested in or becoming kind of mainstream positions in banks or financial institutions. If again, the climate, environment, social issues are extremely complex, and you have specialist skills that are relevant that can add to understanding these issues, but they're typically not present in an investment team or in a risk management team. So I think there's a lot of scope to bring in multidisciplinary teams, and not just across either a risk management function or an ESG screening function of a couple of people in the bank, but truly across, I think, some of the key functions. And there's a lot of, I think, gain to be had and truly benefit on the data on the one hand, but equally the kind of mainstreaming of the insights on the other hand.
Sakis, you want to comment on this? I think Christophe is spot on that this is a multidisciplinary effort, and all actors can come together, especially as we see increasing demand from consumers, clients, depending on the sector you're operating, employees, but also the desire of individuals during their time at university. You mentioned universities, to study or work on topics that are more, you can call it mission driven, or they resonate more with their beliefs. So in that sense, bringing those actors together doesn't just unlock the potential for artificial intelligence to help us process the data, but it's also market driven, because there's a lot more demand from individuals to better understand companies they invest in, products they consume, and choose jobs that have a higher purpose. So I would say 100% a multidisciplinary effort, and we'll see more and more of these partnerships going forward.
Thank you, Sakis.
The only thing I would add is just that
go ahead, Karen.
When we talk about these multi-actor efforts, I feel that government is actually sometimes under-focused on, because there's almost an assumption that who knows if they'll do their job, and we're all here kind of trying to, be the private sector leading the way. But we shouldn't let them off the hook. They're actually a very, very important actor, whether it's regulatory, like forcing that data will literally be produced, or, in standardization. And a couple of analogies I'd think about what government did for something like the mortgage market, in terms of what it means that they stamp mortgages and how much money goes into mortgages, because people just know what a Fannie or Freddie mortgage is. Even if there wasn't a guarantee behind them, government played a tremendous role in making a home available for everybody. Doesn't feel like government has cracked yet how to do that for something like the sustainable finance space. And there's really that possibility there. So we shouldn't let them off the hook. They're also a very, very, very important actor to kind of have in these conversations.
Totally agree, Karen. Maybe we'll take the last 5 minutes, and I would like to hear you, and that we can project ourselves and use maybe an AI algorithm altogether to project ourselves for the next 3 to 5 years. And really, I would like to hear from all of you around looking ahead and keeping in mind the fast-paced evolution of AI and sustainable finance. How do you envision the progression or the evolution in the next 3 to 5 years? Maybe I'll start with Karen, I'll go to Christophe, and then Sakis, and then we can go to the questions of the audience. So Karen.
I think in 5 years, there's no major investor to this won't be core to how they do things. It'll be broad to their whole portfolio and not some small side team. And most importantly, it will hit many more of their asset classes. Right now, the over-focus is on equities. There's a lot of capital and fixed income that just hasn't really touched this conversation to the degree that it could. And honestly, the difficulty of investing in fixed income and thinking about these issues, whether it's municipal or whether it's thinking about it with corporates, is much greater because the instruments just haven't been created. I think it'll be much easier. And then lastly, the data ecosystem will just get radically better. All the weaknesses that Sakis spoke about, they're going to improve over this period.
Thank you, Christophe.
I think, echoing that, in a way, I hope in 3 or 5 years, we on the one hand won't be talking about sustainable finance as a separate thing and or AI as a separate thing for sustainable finance. So I do believe and hope it'll be very much kind of mainstreamed, this type of thinking, this type of data, and this type of capabilities across all functions in financial institutions. And that also, I think, because there's still a lot of talk in any moment about data and data gaps, etc. I think in 5 years' time, the conversation will hopefully have moved away from data to how do you use it? How do you drive it action with the data? Or how is progress being made against all these policies, etc., whatever that have been agreed upon now in sustainable finance? So much more of a kind of discussion about the core of the underlying ESG issues than the how to go about understanding it.
Thank you, Christophe. And finally, Sakis.
Yeah, from my side, I would say number one is moving from input level data to outcome level data. So, for example, reducing all these policies. It doesn't matter if you have a deforestation policy if the forests keep disappearing, right? So we should be focusing on what the outcome is. And then moving from scores to insights. I think, and again, on the how do you use the data, having a score 9 out of 10 for a company, it's good, but it's not really insightful. But what would be really insightful is, could we have predicted, for example, that Pfizer could be the first company to bring out a vaccine? Or can you find the next Tesla within the industry when they're emerging? These are investor-related questions that will be very, very useful to kind of analyze with ESG data. So these two things. On the asset class, I would say hopefully some more transparency from the private equity side and what happens in private markets. We have hardly any information, but maybe I'm too hopeful there.
Thank you, Sakis. So I would like to thank my fellow panelists here for their time. Sakis, thank you very much. Christophe, thank you very much. And Karen, for your time and for your very pertinent insight on this very important topic of sustainable finance and digital, digital finance, and how we can make the world better and apply this very important technology and that's coming out and that's going to be evolving in the next years to real ESG problem. And I think you guys showed to our audience today that it can be done, and it's not two different topics that are connected together, and one can help the other. So I would like to thank you guys for the time and the preparation and everything. So I hope the audience really enjoyed our conversation. We're available if there's any questions. I think you guys will be able to answer them. So thank you very much. We're right on time. So thank you very much.